Let's welcome on board who better than Keki Mistry to talk to us about how the next year is likely to pan out. He's of course the former Vice Chairman and CEO of HDFC and Independent Director in several companies. Mr. Mistry, hi, good to be speaking with you. Thanks so much for making time, and here's wishing you the very best in 2024. But banking, as all of us call it, is a bit of a cyclical business, right? Where do you think we are in this cycle? Are we past the peak or at least very close to the peak? What's your analysis?
I don't think we are anywhere even remotely close to the peak. I think the growth opportunities which are there for the economy as a whole, and the banking sector is obviously part of the economy, is phenomenal. I don't think any country in the world today has the potential to grow the way India has the potential to grow. And we've demonstrated that consecutively year after year. I'll just give you some broad percent, but let me first stick to your question, which is on the banking sector. The penetration level of any kind of financial product in India is amongst the lowest in the world, amongst the lowest, if not the lowest. So if you look at mortgages, for example, mortgages today are about 11% of GDP. You compare that with an economy like US or UK or any of the European countries, they're all well over 40%. Some are 50, some are 60, some are 70. India is only 11%. Even some of the emerging markets are in the 20s. So by comparison, we are very underpenetrated, and we have a young population. 2/3 of our population is below 35 years of age, and people generally buy a house only when they are in the late 30s. So there is a massive potential to grow, not just for mortgages, but for every single financial service product. If you look at retail credit to GDP in India, we are at around 18%. If you look at credit card penetration in India, extremely low by global standards. So whichever way, whichever product you look at, the growth opportunities in the banking system are phenomenal. The challenge, if any, is in the ability to keep raising funds and maintaining the margins, which each bank's expertise, each bank would have its own expertise in terms of managing that. But the growth opportunity, absolutely phenomenal.
Mr. Mistry, hi there. Good morning. Now, given that the RBI released that banking sector health report where the balance sheet in FY23 has expanded by 12.2%, what is your outlook on the balance sheet expansion? Will that continue into 2024 as well? And which segment, according to you, will be the fastest growing?
I would say retail credit is the fastest growing. Retail credit would include housing loans, credit cards, personal loans, car loans, all of that. For the first time in recent times, I've seen that the average Indian, the middle class Indian, is not averse to borrowing money to consume, to spend, which is very different from what we used to see in India 20, 30, 40 years ago. It's still not caught on in a big way, but there are instances where middle income people are borrowing money in order to go on a holiday or to consume or to buy, to invest in some kind of an asset. So every segment of retail credit has scope to grow, whether it's housing loans, whether it's car loans, whether it is credit cards, whether it is personal loans, whatever.
So I just want to probe that point further. You said that corporate will pick up. So as of now, you're saying it's not happening?
It is happening. I'm not saying it's not happening, but it's certainly the pace could get accelerated over time. It is picked up. It has started picking up. There have been signs of pickup over the last year and a half or so. But the real, that sharp curve where the growth numbers could be very sharp, that we've still not seen. Private corporate growth. But in growth, demand for credit for infrastructure, demand for credit for construction, all of that is very, very high.
Mr. Mistry, most probably 2024 will also be the year which will mark the reversal of the interest rate cycle. What's your own expectation of how that will pan out? How much reduction of interest rates do you expect? And how will it impact the banking sector?
All right, so let's first talk of my view on interest rates. I have been saying for a while now, for more than 6 months, that I think interest rates have peaked. And I've also said that at some point of time, in my opinion, and I've said early 2024, is the time when I would expect the interest rate reversal cycle to happen. I think RBI will be cautious. We are not going to keep cutting interest rates dramatically for every credit policy. They'll be very mindful and watchful of what is happening in the economy, the kind of growth that is happening, inflation numbers that keep coming out, oil prices. So there are so many moving parts that RBI needs to monitor on a regular basis, and then they would take a call on how much quantity of interest rate reduction you would see. But I don't see it to be very sharp reduction, but I do believe that in the first quarter itself, we could see a 25 basis point cuts in interest rates. That's my personal.
Right. And there's been improvement in asset quality of banks as well that began in 2018 and 19, and that continued. Is there any danger of asset quality deterioration as we step into the next year?
In my personal view, not a high risk. If any, it will be a very insignificant risk, in my opinion. The non-performing loans of the banking system as a whole in March, if I recall right, were 3.9%. And 3.9% is one of the lowest numbers we've seen in a long time. And also, non-performing loans today are reported by banks, very correctly and very conservatively. So a loan which is today reported as a non-performing loan could 5 years or 7 years later may not have been reported as a non-performing loan. So we are following very strict measurement criteria in determining what the NPL number is. And even with those strict measurement criteria, we are still amongst the lowest we've been in recent years. So I don't see any real significant risk to asset quality. A marginal tick up could happen in unsecured loans, but I think it is marginal. And to the best of my knowledge, again, I don't think banks or NBFCs are the ones who are more prominent in doing this, have seen any deterioration in asset quality so far. But I think RBI's concerns stem from the fact that the growth of unsecured loans was much sharper and much faster than they expected. And therefore, they thought that if that kind of growth continues, then it could pose asset quality risks in the long term. But today, I don't see that risk.
Okay, so that's good to hear because there's been a lot of chatter about this unsecured lending and the latest, diktat of sorts coming in from the RBI of late also suggested that, but you are rebutting all of that. But there was an interesting news piece a few days ago that RBI is actually increasing the term deposit rate. And this is coming at a time when we're at the cusp of the rate cut cycle. How should we read into this?
No, I think what it means really is that the savings habits of people in India have changed. I mentioned to you earlier that people are now much more willing to borrow money and spend money or consume. So people are spending more and more money, and savings have therefore come down. To some extent, inflation has also had some effect in people's savings. Because if you look at interest rates, someone who was taking a loan who had taken a loan at, let's say, 7.5%, for example, is now paying 10% on that loan because we've seen a 250 basis points increase in interest rates. Now, a 250 basis points on a 7.5% base is almost a 33% increase in interest rates. So it has, to some extent, affected the people's ability to save money, but that's not the full answer. The answer is that financial systems and the financial savings in the system as a percentage of total savings has come down a little bit. People are looking more at physical assets. People are looking more at, buying houses and things like that. So it reflects that. In my view, this is temporary. There are also a lot more avenues for people to save in financial instruments compared to what was the case, say, 10 years ago. You can today put money in. There are more sophisticated products from mutual funds. There are insurance companies where you can save money with. So there are various other alternate opportunities for people to save money, and it's not just only bank deposits. So that could be part of the answer. But at some point of time, these are cycles. Some point of time, people will move back away from physical assets into financial assets. And at that time, banks will again become a more popular mode of saving money.
Mr. Keki, that's very interesting because this is the same point Mr. Uday Kotak has made in his musings for 2023 and 2024 today, because he says as savers become investors, the banking sector faces challenges on its deposits and cost of funds. Does it mean that war of deposits is going to get more heated up in 2024 and the lag of deposits to advances is likely to widen?
We have seen that consecutively, quarter after quarter, month after month. So whatever data I have seen, there has been a lag between loan growth and deposit growth. So loan growth has always been faster than deposit growth. But if you see that lag is slowly bridging. It's still not bridged, but it is slowly bridging. But even today, the growth of loans is more in percentage terms than the growth of deposits. But having said that, as I said, that gap is bridging. And these are cycles, as I said, so people will at some point of time, whether that's 1 month later, 3 months later, 8 months later, I don't know. But at some point of time, people will start moving back to financial instruments. Now, in financial instruments, yes, there is competition, but the banks are a very, very, very big part of that pool of capital that is available.
Okay, so that makes sense. Thanks, Mr. Mistry, for explaining that. But you're also strategic advisor to the Poonawalla Group now. What's your take on the NBFC sector and the Poonawalla Group? And I ask you that because there seems to be a bit of worry, which RBI is talking about it in one way or the other of the type of lending that's happening from banks to NBFCs.
I think, I was very pleasantly surprised when I first went and saw the balance sheet. I think their ability to grow is phenomenal. Their margins are huge. They run with very good margins. Their NPLs are very low. They have a very, very effective system of being able to deliver loans very, very quickly. So I've been very impressed with what I saw with the company. Now, having said that, talking of the NBFC sector as a whole, I think NBFCs play a very important role in the financial system in India. There are certain categories of loans, certain locations, certain types of credit, which banks will always find it very difficult to do. And NBFCs specialize in those kind of loans. So NBFCs have a very, in my opinion, extremely important role to play, a very niche role to play, and they can play that role in specific sectors, in specific products where they would develop a lot of expertise. So I think NBFCs in India have a huge future, as good a future as the banking system is. And you must remember that the lending rates of these NBFCs will be a little higher, typically because of the fact that one is the cost of fund is higher, but more importantly, they are lending to segments of the market where banks would not be able to reach out to or would not be willing to lend.
Okay, so NBFCs have as much a brighter future as banks, if not more. That's the key takeaway. Thanks, Mr. Mistry, for making time and speaking with us, and best wishes for the year ahead.